The Punakaiki Fund has been in the market with a wholesale offer hoping to raise up to $10.5 million to invest in new and existing portfolio companies. And joining me now is Lance Wiggs, who's a partner in 2040 Ventures, which is the manager of the fund. Well, Lance, how's the offer gone?
Well, we haven't got $10.5 million. We've got about 10% of that. And so obviously it's pretty disappointing so far. And we are in particularly disappointed because we've had a really good year. While the markets themselves, the stock markets, the bond markets, the currency markets have taken a real big dip. We've kind of been waiting for Judgment Day in a way to prove that we haven't been overvaluing our investments, and it's here. And we would have expected a stronger result than we've had so far.
Why do you think it hasn't been attractive to investors?
Well, probably three things. So the first is that investors are humans and they've watched the value of all their other investments go down quite a lot. And perhaps they don't want to free up some cash by selling at a big loss, or perhaps they just don't really want to think about investing at the moment. And we find these are quite common psychological things that do affect people when it comes to investment. The entire tech sector's it's had a challenging year. And maybe people think there's more to come, and there may well be, and we've factored that into the way that we think about our investments as well. The second one is we are on a new platform, the Catalyst platform, so it is different for investors. Our previous way of marketing to our investors was to using our own platform, an outsourced platform, which just made it probably a bit easier for people to onboard, say they're the wholesale investors and off you go. So there's a new process to learn. That said, once people are on the Catalyst platform, it's a lot easier for them to invest in subsequent rounds in not just Punakaiki Fund, but the Climate Venture Capital Fund and a whole host of other funds and investments they've got on that platform. So it's early days, I guess. And the third one is maybe the chilling effect that the FMA has had with the wholesale certification study they've done recently with the property funds. And that's had an ongoing effect into everybody in the market. It does mean that the lawyers and the AFAs and the accountants are a little bit less excited about certifying their investors as wholesale, because the FMA has actually said that if you do so in a way that's reckless, then they will be reporting you to your statutory authority, to your licensing body. So we're doing something about that.
To sort out who is a wholesale investor and who is actually a retail investor.
It is good, and we could talk for hours about what a wholesale investor actually is and maybe should be. My own argument is that the law is perhaps not quite fit for purpose in identifying people who are truly, wholesale investor and able to make those good decisions. This is a step in the right direction from the FMA, that it does require the lawyer and accountant and financial advisor to make inquiries and for you to actually write down the reason that you know how to assess these particular products. But that just makes it harder for people to decide to invest. So when you go to invest, you've got to sign up, identify yourself through the AML process, which we all know is very painful. Then you've got to go through the wholesale certification process. And if you have to involve someone external to you, then it's just going to slow things down. So we're doing something about it. What we're going to do is that we are offering $400 to pay for any cost that the financial advisor, lawyer, or accountant charges to our investors, if they invest in our products. We're doing that just to help smooth the waters for people as they decide to invest. And we think that should have a good impact. We're not quite sure, though, of course, because it's not the money that matters so much to people, it's the painfulness of the process.
So are you keeping the offer open then till the end of November, or what's your plans?
Yeah, we've got two offers at the moment. We've got the Punakaiki Fund offer, which is going to close at the end of the month. We have our board meeting towards the end of the month. We'll close at the end of the month, and then we'll have a share trading window in December. And then for our Climate Venture Capital Fund, we're closing that, basically before the end of the year. And
how's that fund gone?
We have about $10.5 million in the Climate VC Fund, and we've already made 4 investments, and we're pretty excited, actually. One of them has already done its follow-on round, and which we invested in as well, which is MGA Thermal, an Australian company that makes bricks that retain heat very, very well. And we've made other investments in New Zealand as well.
What were you seeking to raise for that fund?
If I'm honest, when we originally started thinking about it several years ago, we said what we really need and where the easiest money is a very large private equity fund in the hundreds of millions of dollars. And that remains the potential. That's where the bang for the buck is in climate, because sometimes it's not just about identifying the stuff that might, save us if the company works. It's about taking the companies that are working and really accelerating them. And there's huge amounts of money to be made in that. So that's still the ambition, but it won't be for this fund. This fund, we were looking for, say, 20 million as our target minimum. I've always thought in my head that 10 was probably going to be the number that was our real minimum, and that's where we are. We'd like to, fill up the coffers a bit more, keep investing, show the results, but we'll very quickly move on to perhaps looking at a larger, more institutional fund in the medium term.
Just returning to Punakaiki Fund, if you only get the amount you've raised to date, what does that mean in terms of what you can do?
Well, it means that we're okay for another year in terms of our ability to pay for ourselves. And we always know we can raise money if we want to from our investors by doing a discounted rights issue or a wholesale offer or a retail offer rather. We didn't do a retail offer this year, by the way, Fiona, so that was probably another reason that was hard for us. So that's good, but every dollar that we raise from now on will actually turn around and go into companies. So it does make it harder for us to invest in companies. We're incredibly capital efficient. We've raised about $47 million over the years, but we've actually invested $58 million. That's because we recycle the money that we get from exits and put it back into the ecosystem. So we've also taken that $47 and we're now worth $96 million as in June, and we're showing some good resilience in the early look at the valuations. So yeah, we've done very well for our investors. We've done very well for the ecosystem, and we're a pretty safe port, I think, in these turbulent waters these days.
You've got a different model to most of the other funds. So you're an evergreen fund, which does mean you're sort of constantly raising. Isn't that a distraction? And is it, in hindsight, is it the best model?
Yes, it's a distraction, and I certainly didn't sign up when we started the fund to be raising every year. It's quite painful. In fact, we started the fund to lower the effort of raising from companies because we saw that it was incredibly painful for them to raise money. So if we could turn up with cash just as they needed it, as opposed to them having to go around and around everybody, then that would be good. We never really achieved that goal, aside from 2 or 3 investments over the years when we were flush with cash. But and it's incredibly difficult raising money. But we had no choice. When we started this in 2014, 2013, really, you could not mention venture capital to investors credibly because it was a place where money went to go to be lit into fire and disappear. And that's what had happened over the previous 10 to 15 years. And now you can say, yes, the asset class works pretty well in New Zealand. And in another 10 years' time, people are going to be saying, why did we under-allocate so much to venture capital in New Zealand? Because what we're seeing coming through across the ecosystem, across portfolios, are some amazing companies. And they're going to pop. Some of them have already popped. Others are popping as we speak, and we can't talk about them as an ecosystem. And you're going to see some, the zeros of tomorrow, continuously emerge, I guess, from the ecosystem. So we're really excited about where we invest. But it's the evergreen approach. It's hard for what we now have is an emerging class of investors who will invest institutions in general partner, limited partner structures. We didn't have that 8 years ago, aside from PE. We also have an emerging class of retail investors who like to invest in exciting stocks. And you can thank Sharesies for a lot of that because they've really brought excitement to the stock market, which is fantastic. What we've struggled a little bit with, we're in the middle. We've got over 1,000 investors who really understand and get what we are about and enjoy what we're doing and the returns. But we've never really got the private capital investors to come across because they look at us and say, you're a bit unusual. And that includes the government.
Is it too late to change the model, though? Obviously, because
it's way too late to change the model. We did a study on that this year, and we said, no, it's just not worth it. It's not tax efficient. and it's not what our investors signed up for. So we're going to IPO. That's very much the game on. So we had 2 people start last week. One is Ben Kay, who's our new CFO, and his main mandate is to bring us to IPO. And the other one is a chap called Tom Cully, who's our new marketing director, and his main job is to help with that process. And so we're very much focused now on getting up and running towards that IPO. Hopefully next year, we'll see. And then talking to the larger investors who are in the equities room, not the private capital room, and saying, hey, we give you great exposure to early stage, mid stage technology in New Zealand, which basically isn't really in many people's portfolios and should be.
So you sort of hit pause on the IPO idea in 2022. What's going to be the catalyst for saying pushing the green light, really?
Oh, I think we're getting close to being ready ourselves. That's never really been the problem. We've done, I think, 7 PDSs, which is pretty astonishing, really. The catalyst is really around getting the critical mass of investors. And to be fair, that's actually coming from Australia, because there's a lot more risk appetite over there for technology. They're a much bigger market, obviously. We'd love to see more energy and effort coming from New Zealand investors, but they often tend to be, focused on, more generic portfolios, I guess.
So 2023 for an IPO, and is the climate, you're saying the climate has affected your ability to raise funds. Is that the same for your startups, do you think? I mean, what do you think the climate's like at the moment for startups trying to raise funds as well?
I think it's similar, yeah. So there's a flight to quality with companies, as you see whenever you have a downturn. And we've been through, feels like 2 or 3 cycles at Punakaiki Fund of watching valuations go up and down, and we're always there. And we look at the companies and say, well, are you sustainable? Are you growing? Are you in our mandate and all that sort of stuff? And you basically afford to pick and choose if you have money. We don't have money at the moment, so it's quite painful. We're seeing some amazing opportunities and at pretty good valuations, and we're unable to invest in them. And it's quite painful. But in general, we're saying to companies, as all the other VCs, treasure the cash. Maybe trim the sails a little bit in terms of your forecast and your expectations around hiring. Get back to cash flow positive. And obviously, as always, growth is everything. And we're absolutely seeing that investments rounds are, we're trying to say, well, we can give you some money to keep going for another year or another 6 months. You'll get a much better round away because you'll be bigger and so on. That said, we did help Quantify Photonics get a $25 million round away with really strong support from New Zealand VCs as well as Intel Capital. I think you'll still see a few very high quality deals go through in the market.